All right. So how you all doing? So just like I predicted or just like I forecasted, we have made an all-time high. Okay. If you can go watch my past videos, I believe pretty much all my past videos, I had been forecasting that we will make an all-time high, and there was a high probability that we're going to make an all-time high. That pretty much, I believe, had been um, my first scenario or my best case scenario. And here we are, we have made an all-time high. So the question now is, what next? I have quite a bit for us today. We're going to take a look at the overview of the market based on Elliott Wave, kind of looking at the larger cycles. And then we're going to drill down to the more smaller cycles, okay? Also, we're going to take a look at the 10-year yield minus the 2-year yield, look at history, what had happened in the past, and what we should expect going forward. So please stay with me throughout the end of this video. And also, I would like to request that if you like the content, please subscribe, like the video, share the video. It's going to help me a whole lot with the YouTube algorithm, and I really do appreciate that. All right, so we're going to take a look at the correlation between the 10-year yield minus the 2-year yield and SPX. What you have here is the 10-year yield minus the 2-year yield, and what you have above is SPX. Now, when this uninverts, you will see that there's a correlation between the uninversion of this. That is when it crosses the zero line. This blue line is the zero line. When it crosses above it, there is a decline in the stock market, a downturn, or in some cases, a crash. All right. So this is the first instance, and as you can see, it correlates to January 1990. That's from at this point. All right. And if we take a look and see by how much this corrected, it's about 19%. Yeah, so about 19%. Okay. So that was the first correction. Now we keep on going. We come to this point. This was the dot-com bubble. This was in 2000, 2001. Actually, by the time the yield curve had uninverted, the decline had already started. However, it still falls within the same time frame. And let's take a look and see by how much the stock market declined. And this is SPX. Nasdaq was a lot worse. And we're going to take a look at that. So you can see SPX went down about 50%, 49.78. So let's call that 50%. This is Nasdaq. Nasdaq went down 82%, okay, or a bit more, almost 83%. So that was a lot. So let's keep going. Let me take it back to XPX. So this was the next uninversion, and this was in 2007, and this was the global financial crisis, the GFC crash. The yield curve uninverted here, and the decline started around here. All right. So a couple of months after the yield curve uninverted, the decline started. Okay. So this is a monthly chart, by the way, and this decline was also significant. All right, 57%. So let's keep going. Let's see what next did this uninversion happen. Take a look at this. This was a little, it just nicked it and then uninverted here. And after a while, the decline also took place here. That was the 2020 crash, COVID crash. All right, let's keep going. And here we are. This is the next one. All right. We have uninverted. So what's going to happen next? There's an expectation based on past correlations that we're going to have a crash. Okay, a major crash. All right. When it's going to happen, no one knows, but pretty soon. That's why I keep on reiterating. Please be very careful how you invest at these times. The market has gone up so much. If you want to invest, leaving your money there for 5 years, more than 1 year, anything more than 1 year is a little risky. You might want to rethink it. it's better you go into the market, come out, go in, come out. So pretty much doing swing trading. And if you're a day trader, well, this really doesn't concern you, okay? So this is an overview and analysis comparing SPX or comparing the market, okay, to the earning version of the yield curve. Next, we are going to take a look at the Elliott wave analysis. Okay, so this is the EW analysis, larger cycles all the way down to the smaller cycles. And we're going to look at the smaller cycle, but this is the larger cycles, okay? I started in 2022 from the 2022 decline. As I said in some of my previous videos, on one of my previous videos, this correction could be even larger, but you're going to take it a step at a time, all right? You don't want to, assume too much because the market can be irrational. So from the 2000 decline, you have 1, 2, 3, 4, 5. For this particular cycle, that's taking us to 6,700 and then a much bigger correction. So this is an overview, and we're going to zoom in a little much closer to take a look at what's going on right here. So if you remember my past analysis, I predicted that the market was going to make an all-time high. The only surprise here is that the market just went straight up. I would have thought that once it came to this area, it will correct and then keep on going up, but it just keeps on going up. So this is SPY, and I'm using the extended trading hours. My thought process is that this is a 1, 2, 3, 4, 5. All right. So this correction is still, I think this correction is still going to come down a little bit more. Or you could stop here and keep on going up, but I think it's going to come down a little bit more. Then we go up. All right. So when we get here, we have this correction. Okay. Down to like the 6,000, and then we go back up. All right. So when we get back up here, we will now have a bigger correction, just like I showed here. We will now have a bigger correction down to 5,500 area, and the market goes back up again all the way to 6,700. So in a nutshell, that's really what I have for you today. Trade very carefully, and I wish you all the best, trading. So just to summarize, I think we still have some ways to go up before a much bigger correction. So be very careful when you're trading, and I wish you all the best. God bless you. Thank you.